All right, we've got about 40 seconds until we get things going for tonight. Finally got all my windows up and where they need to be. I've got Thinkorswim open. Perfect. We are almost ready to go. Thank you to those of you who are patiently waiting as we get ready to kick things off. 20 more seconds to go, honestly. I'm kind of sitting here just waiting as well, so let's just get things started. No need to wait another 13 seconds. Camera on. Let's see. There we go. Welcome back to another weekly stock market scan, option selling analysis, whatever you want to call it. We are back. It's the second week of December. Let me scroll down. Actually, you can't even see my screen yet. But we definitely have a lot to talk about. It's going to be a very busy week in the market. This upcoming week, we've got CPI. We have FOMC. Those two events independently are often very, very volatile by themselves. So the combination of those two this week, we could definitely see some excitement in the market. So that's going to be at the forefront of our mind as we recap last week and discuss what we want to do for the upcoming week as we put together a little bit of a game plan. So without further ado, let's pop on the normal one, put myself down in the corner. There we are. And let's scroll down and talk about how we did last week. We had a pretty good stretch going, and I probably should just tab down, go over like so. There we go. Last week we lost about $3,906, which is a tough break, right? We never want to be losing money in the market, but we also want to view that in context of what happened during the week, right? So the S&P 500 dropped 3.35%. That's a pretty big dip in 1 week for the market, and we dropped 2.17%. So we did outperform by 1.18%, which is decent. That objectively is good, right? If we outperform by 1% every year, we're going to outperform, or 1% every week, we're going to outperform by like 50, 60% over the course of the entire year. So from an outperformance basis, good stuff. However, when we have deep red weeks like this, we typically want to outperform by a little bit more because when the market runs away and has a big green week, yes, we make money, but we typically underperform in those weeks as well. So I like to think of these big red weeks as where we make our money as far as outperformance of the market is concerned. And there are a couple reasons that we didn't necessarily do as well with that as we would have liked. The first is going to be Carvana here, which we lost 1480. This was almost half of our loss this past week. And to talk a little bit about that one, let's just pull up the chart and talk about what happened with it. We knew that this one was a little bit riskier of a stock. We talked about how we previously had used it pretty successfully to make some money selling option premium. And we mentioned specifically last Sunday on the stream that we wanted to wait for some red from Carvana, a big spike in implied volatility to enter in. And you could see on the chart here, there's some big red from Carvana. There's a big spike in implied volatility. These are the things that we wanted to wait for. Unfortunately, we entered right about here, I think, which not ideal for us. So we bore the brunt of that dip. Now, had we held on, we could have made a little bit more money back, but it was one of those things where the reason Carvana dropped so much was there was bankruptcy rumors. And typically bankruptcy is a little bit convoluted of a process. It doesn't just kind of happen like that overnight and a stock goes to zero. So that's kind of the spike you expect to see, but you really never know when it's going to spike. And with things like that, we like to play it on the safer side of things as opposed to taking that kind of a risk. But with that said, we wanted to wait for this kind of a move with this corresponding implied volatility spike. We got a little bit impatient. We're looking to spend some money. That was a mistake on our part. With those risky ones, you want to really wait for something like a can't miss opportunity on those types of stocks. We had a decent entry, but not like a can't miss opportunity like presented itself the day after. So we lost a little bit of money right there, and it's definitely a good reminder about what type of stocks we want to target, what kind of cushions we want to give ourselves, and what opportunities we want to use to enter on those riskier stocks. But with that said, it was a little bit cheaper of a lesson than things have historically been when we've made big mistakes. So we set $1,500 on fire there, but we keep moving on. The other two sizable losses were between ASTS, which lost us about $1,100, and then Affirm, which lost us about $1,400 during the week as well. Affirm, I'm kind of okay with because we have a path back on Affirm, right? If you look at what happened to us with Affirm last week, we lost $1,300. And Affirm started last week. I think we could look up here and maybe find it. Yeah, Affirm started last week at $14.62. So what we saw from Affirm, if we pull that chart up, was a pretty significant drop here over the last 5 days, right? Going from that 14-ish level down to below 11 at one point, and then finishing up at about 11.31. So we use the tools that we have in our toolbox to manage that kind of a drop, right? We started a little bit smaller. If we take a look at what we did last week, we started with our initial 5 contract size. Then we added 5 more contracts of the 13 strike puts as it dropped and dropped. And then eventually we scaled into that third tranche of the set of 5 different contracts right here to have our 1, 2, 3 full size position, 15 contracts total. And it did stop the bleeding a good bit, right? We did lose some money on this one right here, but what we did was we went from a 14 strike minus 49 cent would be a 13.51 break-even price to start the week. And by the end of the week, Affirm, this isn't entirely accurate. Our break-even price was roughly, should have been 14 minus 0.49, minus 0.49 again, minus 0.45. Our break-even price got down to 12.57 by the end of the week, right? So we took our break-even price from about 13.5 to 12.5 just by scaling down. And that $1 reduction in break-even price might seem like whatever, but when you're talking in terms of a stock that's trading for around $10 a share, that's a roughly 10% decrease in break-even price. And Affirm saw a massive dip last week, which is unfortunate. But with that said, we're going to try to manage that. So it has gone from 14.5 down near 10. What are we doing this week to make that money back, right? We want to look at a kind of on a 2-week basis when we manage some of these losers. So we lost $1,355 last week on Affirm. The plan this week, typically, you'd want to sell an out of the money put, but we went slightly in the money on Affirm, selling a 12 strike put. So if it goes back to 12, and we could play the game right here where if Affirm goes to 12, that's going to expire worthless, we'll make back $1,070. No, we're not going to make back the entire amount. It'll still be a net loss of $285. But objectively, look, you could put yourself in a situation where Affirm will have gone from 14.5 to 12 on a 2-week basis, which is just south of a 20% drop, and you'll have only lost a couple $100. And that's a pretty good trade-off. And then, of course, the week after that, you can go back down to your 5 position size and recoup that $285, taking risk off of the table. So that's kind of the game that we're playing right there with Affirm. The other one was ASTS. We lost about $1,000 on that one. And it really has just been flying off the face of the earth. This is one I'm a little bit hesitant on. It is a former SPAC. It's definitely one of the better companies maybe that was taken public, but still nothing to go crazy about. It's a space satellite company, which I always think is an interesting area to invest in. Just because of the forward outlook, right? You can get some decent multiples on those types of companies. Parlage Capital, if I pronounced that right or wrong, don't know. Thank you for the follow. But with these space companies, they're a lot more forward-looking. They've already had some successful launches. They had some dilution around $6 a share, which caused a couple of these larger candles. But if you dilute the shares at 6, you've got a lot of owners at the stock up here now. So I'm not too worried about getting in at 434, and especially if we look at this on like a 180-day basis. This is a decent place to own the stock at. And if it goes to 0, look, it goes to 0. It's not going to happen overnight again. But we want to be careful about increasing our position size further from here. Because right now our position size is about $8,400. That's about 5% of our account. So, not too big of a size. It won't kill us if the stock goes to 0. But I still think there's some upside. And I think there's some merit to getting in at this level right here. So that's what we're currently sitting in, right? And if we want to play the game of looking at it on a 2-week basis to say, okay, last week we lost about $1,100 on ASTS. How much can we make back this week? If ASTS goes back up to 5, oops, I accidentally went into FTCH, but if ASTS goes back up to 5, we make back $1,070, which is enough to bring us back to basically dead even, right? So we had that ASTS position where we started last week and ASTS was trading at like 6-ish a share, I think is where it was last week. Our break even is now down at 5. And again, that $1 decrease in break even price is very significant for a stock like this because that's like a 25% reduction in break even price in just 1 week. So if it just hangs at this level for another week, right? And it stays where it is at 427, we're going to recoup $100, which isn't very much, to be honest with you. And a lot of that's because it decreased a little bit on Friday after we entered into it. But it was at about like 435. But even if it gets back up to like 440-ish, which isn't by any means coming back through the roof or anything, we recoup about $400 right there. We roll the position to next week, and we just keep the line moving with our break even like 20 cents lower. So again, that's the biggest thing we want to emphasize with this option selling strategy on a week-to-week basis is Just because our trades on a 1 week basis have expiries doesn't mean that the trade is over at that point in time. The great part about this is if we lose 1 week, that's okay. A lot of this, we use these option selling strategies as almost a proxy for controlling shares. And we can control these shares as long as we want by continuing to sell week after week after week. And the only guarantee in the market is that the extrinsic value on these options that we sell is going to be collected at expiry time and time and time again. And having cushions like what we see right here with our break-even tracker, the cushions that we've set ourselves up with for the next week in the market are going to be very, very useful to help combat some of this potential volatility that we've seen. So with that said, those were kind of the bigger losers. MSOS, I think, was maybe an interesting one to talk about really quickly. There's been some legislation with MSOS that's been on the floor of the House that people have been messing with for a little bit of time, and we've seen some serious volatility. This isn't unlike anything we've seen before in MSOS. The one thing we want to keep in mind, long-term trend, we look at the 180-day chart. It's been hanging out around 10 for a decent amount of time, so 10 is a level that I'm pretty happy to be investing in it at. And this 180-day trend that we see here indicated by this blue line, it's a steady rise in implied volatility. What does that mean for us? It means that these options are going to have more and more and more premium for us to sell. And MSOS has been a great stock for us historically. I think last week was actually the only time we've lost money on an MSOS position. Yeah, we lost about $190, and that was the first week in the last like 2 or 3 months that we've lost money on it. Right? If we go 2 weeks ago, we made $350 on it. If we go the week before that, there was $300 we made on it. MSOS, $200 we've made on it. I mean, this is gonna kind of be irrelevant the more that I do this, but all these MSOS puts that we keep selling at this 10 strike, right? Over the past month, that's like $1,000 in profit, even with this loss. So with that said, we just do what we need to do. One thing that I thought we did very, very well here was manage our risk on a daily basis, right? MSOS, the position by itself, is about 6% of our account. If we double that, that goes to about 10, 11, 12% of our account. That's a level that we're comfortable being at with the position kind of full-sized, so to speak. We don't typically like to go too far over 10% of our account for one position. But we had that opportunity, and we took advantage of it because MSOS dipped, right? And almost went down to, I think it might have hit 10 on Friday. I'm not entirely sure. Let's look at the 5-day chart. 10.01, it didn't quite hit 10. But we see this general decline during the week. We see implied volatility elevated. We see that RSI is starting to get lower. So what we did on Friday, knowing that there was some potential government-related risk with some bills that are cannabis-related being on the floor, we waited until Friday to open up a 10-strike put. Like it could have been very easy for us on Thursday afternoon to sell a 10-strike put and say, hey, let's just double down. Let's take 30 cents a premium. But a lot can happen overnight, right? We saw it with Carvana. We've seen it with other stocks. We don't want to take that risk because if we double down and then something happens, where's our plan B? We used our plan B Thursday afternoon. Something bad happens Thursday night. We're screwed. We always want to have that plan B in every single trade that we enter into in our back pocket. So we waited until Friday to do that because the likelihood of something happening, as far as legislation is concerned during the day on Friday was much lower. We didn't have that overnight risk. And it paid off. It turned what would have been a $400 loss on MSOS into a really, really nice I guess not too nice, but a much more palatable $190 loss. So what have we done for the upcoming week on MSOS? The great part about MSOS is the premium is still very, very elevated. So we were actually able to sell an 11-strike put for $1.45, meaning that our break even for this upcoming week is about $9.55. And overall, since we lost about 19 cents worth of value, it's sitting at about $9.74 overall. So even though we've endured this kind of a dip over the last 5 days, so long as MSOS stays above $9.74 by Friday, on a 2-week basis, we're going to have made money. And if it just comes back up to this level right here, just above this red line at 11, we're going to hit max profit on this. We're going to turn a profit next week of $1,450 on MSOS, and we'll be off to the races thanks to that one. So that's what we've got there, and that's a good recap of what happened to us last week, right? The market was down, so it's okay to lose money when the market's down. I can't emphasize that enough. It's going to happen. If you're trading something that is, relatively bullish as far as delta is concerned and correlated with the market, which we should, because in theory, the closest thing to a guarantee in the market is that it's going to go up in the long run. So we want to be somewhat bullish majority of the time. Exceptions are when RSI for the S&P 500 gets way, way, way overbought, and we've talked about examples of that. But with that said, it's okay to lose money. We outperform. That helps us accomplish our goal. There were a couple spots like ASTS and Carvana, CVNA, which we got some bad luck on. But hey, luck is part of the game. You need to be prepared for it and just put yourself in a position where bad luck isn't going to completely blow up your portfolio or set you back multiple months. Because for every instance of bad luck, even though it definitely hasn't seemed like it so far in 2022, sometimes there are equal instances of good luck. And that brings us to this upcoming week. Let's talk about what we have planned for the coming week, the week of December the 12th. I guess it should be the week of December the 11th because that's today, and today's Sunday. Deep breath. Where are we? So with that said, right, we're coming off a week where the market dropped 3.35%. Things are looking a little bit more, I guess, as far as levels are concerned, it looks a little bit better, right? Let's talk some macro trends here. Let's look at the S&P 500 on a 60-day basis. RSI down to 37. That's exactly what we like to see before we scale in a little bit further to trades. Can RSI go lower than this? It absolutely can, right? We've seen instances where it gets down into the blue, and that's when we really want to start deploying capital. But there's a little bit of a balance we want to strike, right? Remember what we said at the top of the stream. We have FOMC, we have CPI, and we have an overbought market, or an oversold market rather. So we want to balance this want for adding more of these positions that are oversold with managing risk of a potentially volatile event that's right around the corner during the coming week. So how do we strike that balance where we keep a smaller percent of our account at risk, yet position ourselves where we still make money if the market goes up? And I think we've struck a very good balance of that if we take a look at what we have for the coming week. And I'm going to take a quick sip of water before I talk about it. That was very good. For some reason, I feel like the water in those tumblers, some ice water that's been sitting there for a while, a lot better than normal water. Couldn't tell you why. But without further ado, here's what we got for the coming week, right? The balance that we want to strike is, first and foremost, we want to protect our asses in case the market completely collapses. It seems unlikely because it's oversold a little bit. This isn't a position in which I would expect the market to collapse. So we've got two very volatile events that we need to get over the hump before we could start getting to Christmas and celebrating the year. And point number one we have put down to combat that is the fact that we are only using 31.79% of our account fully cash secured. That means we have about 70% of our overall account balance to allocate into trades and scale in further in order to combat a market that goes down. Now, that doesn't mean the second we see a red candle after CPI or FOMC, if that is the case, that we just start piling in and throw 100% of our money in. No, it means that we manage our break-even prices the way that we are supposed to, meaning that when our break-even is breached, we increase position size. Excuse me. And we always want to be careful not to go above like 10% or anything too crazy as far as these position sizes are concerned. So we want to be cognizant of that as we head into the week. But that's the first and foremost, that's the most important thing that we're doing. And it's starting with a smaller percent of our account fully cash secured. The second thing, which is the balance here, right? We wanted to balance the risk by having some smaller positions, but we also wanted to balance the potential for the market to shoot up. And we've done that by selling things that are closer to the money or in the money in some positions for some of these cash secured puts. MSOS is a great example, right? It finished last week at 1022. We sold an 11 strike put, so we've got about like 80 cents of upside on that position in addition to the extrinsic value that those are holding. And the point being with that extrinsic value is, look, if MSOS doesn't move for whatever reason and ends up at 1022 right where it started the week, we're making $670 from that position purely off of the extrinsic value. Now, if it pops back up to 11, this is fantastic, right? We make $1,450 off one position, which is only 5% of our account. That's fantastic. I love the premium on MSOS this week. And why do we like MSOS a little bit more than some of those other cannabis stocks? It's because MSOS is an ETF. So if one cannabis company or something like goes out of business as a result of something going crazy, right, that'll play a very, very small part in the price action on MSOS. DraftKings, we've done something very similar, right? It unfortunately ticked down to 1383 at 1396 at the end of last week. But we want to give ourselves a little bit of upside, right? This position still had some extrinsic value, so if it doesn't move from this point forward, we're going to make $130. But again, if it goes up and goes up to like 14.5, which is not that big of a jump, right? It's like a 2-3% jump in the coming week. There you go, $670 right there. ASTS, very similar. We've kind of staggered our strikes here. We sold some 4.5 strikes. We sold some 5 strike puts. Uh, Reason being is because we want to play that bounce back up to 5, right? We have that ASTS chart back there. It's very oversold. It's down in the blue, right? What happens when these stocks get in the blue? Like even the crappy ones like ASTS. Because one, this is a great entry point historically looking at it on a 180-day basis. Two, let's look at the other times that RSI has gotten this low. Most recently, back at the end of October, when it bottomed out around 6 a share and then shot back up to 750 within a week or so. We could look back to even the end of September, where it didn't necessarily shoot back up or anything like that, but it kind of gradually rose from this 680, 690-ish base up to the high sevens, which again, that's plenty of a move to capture the value that we're trying to capture. The great part about these strategies is we don't need some huge rocket upwards, so to speak, as far as price action is concerned, because we've got that extrinsic value portion. We could have things stay dead flat every single week for the remainder of our lives, and we'll make a lot of money that way. But conversely, if things do decide to go down, that extrinsic value that we sell gives us some cushions on these positions, and it helps us out a good bit. But to kind of complete the exercise here, right? Even back in April, we saw RSI get down to 27. And it dropped from 8.2 down to like 7.3-ish after that. So it did drop a little bit, but you just stick with these things sometimes. It can be very easy to fall into the mindset of a losing position, where maybe 1, 2, 3 weeks after another, it's kind of dropped and dropped and dropped. You may in your head say, okay, this thing's never going to go back up again. And we've seen that happen before historically on this one. But of course, things do go back up again. So long as the company doesn't implode overnight, there'll be a green day, a green week, a green month, whatever it may be. You just got to stick with these things and ride them down and try to take that break-even price down as low as you possibly can. So that's the plan with ASTS. And again, we don't need that big of a jump, right? Max profit on ASTS for us is if we go up to 5 and both of these expire worthless for $1,000 a profit. But since we've staggered them, we have equal benefit up to 4.5 at least for both of them. So if this rebounds just 23 cents and goes to 450 in the coming week, we're going to take home a profit of roughly $570 on that. So there you go. Another example where if we get a little bit of a jump, our profit looks a little bit better. FTCH, I think that's a decent one for the coming week. We made a very similar type plan with that one where we staggered the strikes, and coincidentally, they're at the exact same strikes because these two stocks have had a very similar performance over the past few weeks from a price action perspective. But again, if FTCH does not move this week, that's $400 in our pockets off a position that's a combined 5% of our account right there. Yeah, about less than 5% of our account. And then I guess we already talked about Affirm, but last but not least, AMC. Why am I playing this one? This is in that bucket of meme stocks, which I historically have hated and think is not a very good idea to invest in. However, there are some times in which I will make exceptions because I think they're actually a decent hedge against the overall market. This week would be a good example of that, right? We've talked about CPI, we've talked about FOMC, two very volatile events that are coming up in the market. And how do we combat volatility? One way that I propose to combat volatility is just to find the biggest cushions that you possibly can. And if we look at our break-even tracker out to the right here, we have an 11.95% cushion on AMC, meaning that stock can drop 11.95% this week, and we won't lose a single cent on the trade, which is fantastic. And so long as it stays above 550, we're going to make $270. And again, that's on a position that's less than 3% of our account. And even if, that may not be apples to apples with your situation, obviously everyone's financial situation is different and account sizes are different. But that doesn't take away from the fact that this is roughly a 5% return on risk, fully cash secured. So no matter how big or small your account is, that 5% applies to both you and me equally, which is a really, really nice return. And again, this downside cushion applies equally for yourself and myself as well. So I'm actually a big fan of that AMC trade, especially looking at it in the context of its longer term chart as well, right? Our break-even price on that is what, 523. We've got capacity to potentially double down on that trade. The 180-day low here is 505. We never want to rule out the, potential for AMC to slide below that because I do believe that one day it will happen. I don't think it's fundamentally the greatest company of all time, but I do think there is enough buying power behind it. RSI is getting back down where we like, and this is another one that really nicely follows that RSI pattern, where if you see it get down into the red, it's not like you have some colossal spike back upwards, but what you do see is, at least it starts to grind back upwards. And again, the grind upwards is all we need. This thing could drop 44 cents next week, which would be like a 6-7% drop on the stock, and we still make max profit. We don't even need green. We just need like not a lot of red, which is a great value proposition for these types of trades. But with that said, this is where we stand, right? We've got 31.79% of our account. For those of you that have been watching, why is that? It's because we've got two volatile events, so keeping a smaller percent of our portfolio in positions over the weekend is exactly where I want to be, because having flexibility with CPI and FOMC coming up this week is going to be very, very key from a performance perspective. And then two, we've got a lot of these that have intrinsic value in them, meaning that if the stock goes up, we're going to make a little bit of money. Now, the downside to that is, look, cumulatively, our cushion's only like $2,000. But again, that means these positions can lose $2,000 worth of value, which in that case, the market would probably go down decently as well. And we wouldn't lose a single dollar in our account. And if everything was dead flat for the coming week, this is how we like to evaluate our current positions. We take home a 1.11% return, which is fantastic, right? We want to target a 1% return weekly. Why is that? Because if we hit that, we are going to get a roughly, I think, 60-ish% return compounded on the year. So a good place to be from a base perspective. But as is typically the case, we always want to know, like, if the market keeps going down, what do we target? Yes, we want to potentially add to what we currently have, but two, it's also a great idea to use that opportunity of a dip in the market to add more potential trades. And the way we're going to do that is we're going to create a little bit of a wish list down here to the bottom right and talk about what we want to add, both bullish and bearish. And before we do that, I do want to talk about something that we discussed a little bit on the stream last week, which worked out very, very well for us. And I didn't really talk about them before. But the X, where's X, and Peloton right here. We sold naked calls last week for the first time. And I think we went about it in a smart way, and it made us a profit of $320, kind of acted as a hedge against the market. So a couple things, why did we do that? And it's because when we think about the market as a whole, we want to look at more macro, overall, broad trends in the indices. When we looked at this about a week ago, RSI was about 57, I think was the number. So the market was a little bit overbought, meaning we felt that the market was probably going to come back down at some point in the near future. And look, that's exactly what happened. It dropped 3.35% last week. That's a decently significant drop on a 1-week basis. Now, with that said, where are we now? Or I guess talking about that, why were naked calls a good idea? When the market's overbought like that, and then we could additionally identify overbought stocks within that overbought market, I think we have a couple different things working in our favor, and that makes it a good thing to play back down. And I want to talk about these calls because, yes, they are technically naked because there's no way to really sell covered calls unless you own shares, but we wanted a bearish position, and selling the naked calls accomplished that. Now, what was our plan if that went against us, right? We all know about the HT wheel where you take assignment of cash secured puts, and then you sell covered calls on those to continue to reduce your cost basis. Well, we were planning on kind of doing the opposite with these naked calls, right? So if they had run above the strike, we would have taken assignment. And an assignment on a short call is what? It's short shares. So whereas with the normal HT wheel, where you get assigned on cash secured puts and assigned shares, with the reverse wheel, you would get assigned on the calls, be assigned short shares, and then instead of selling covered calls to cover your shares, you would sell short puts to cover your short position. If that makes sense and that follows. I know that probably sounded like it was all over the place, but that was kind of the idea with that, meaning that, yes, if we strike out this week on the quote-unquote naked calls, that's fine. We could scale into the position the same way that we scale into our other trades, and then, raise that break-even price every week for it to fall under, as opposed to lowering our break-even price on a bullish position where we want the stock to go back over it. So that was the plan. We're not really going to need any of those this week because the market's teetering on the overbought section. So, but just something I think we should keep in the back of our mind. Last week was a little bit of an experiment in that regard, but it went pretty well for us. But without further ado, let's go to the scanner and go through our typical process. Let's not do this quite yet. Let's clear the filter and just go to high ROR puts without earnings. And this is going to give us a list of options that objectively have the most premium in the market. The water just gets better and better the more I talk, man. Excuse me. So we've got some very, very significant numbers up here. And I really have no idea what these top two are. We've got MDGL, COMT, and you're seeing these for the first time along with myself. So let's take a look. I've got a hunch that these are biotech stocks, so I wouldn't be surprised. But let's look. MDGL. Let's go to analyze fundamentals. MDGL. And there you go. It's a pharmaceutical healthcare company. They based out at 1522, peak at 280, and finished up at 66.91 most recently. I imagine they have some sort of data that's coming up. That was MDGL. Let's get that one typed in. And there you have it, right? They've been basing in this range, but look what implied volatility is doing. There's got to be some sort of data they're coming out with. How do we figure that out? We go look at the live news feed. Looks like they were down over 11% pretty recently. Looks like they've started a phase 3 liver drug trial. And not a ton of news here, but you can kind of read between the lines with what's going on with some of these options. And you see the market maker move right here, and it's plus or minus $31. This is like a par for the course with these biotech and pharmaceutical stocks, which is absolutely insane, right? You could go to the lowest strike that they offer, which is 35, and that offers $3.80. I mean, probably about $4 of premium, right? There's a massive amount of premium on there. Let's check the volume and see what that was looking like on Friday. Plenty of volume here, not as much volume on the upside. Someone looks like they had a pretty bearish bet, or at least a bullish hedge. And if we go to zoom out even further, right? We go to the 3-year. What's very, very interesting about this is how large this move is projected to be in the context of where it's traded in the last 3 years, right? So this goes back to same time, middle of December back in 2019. And the range here is between 52 and 142. Yes, it's been much higher. Yes, it's been a little bit lower. But if we think about this, right, and we sell a 35 strike put for $4, that's a $31 break-even price, meaning it would have to go below here for you to lose any money on that. Now, I say all this, and I realize that the words I'm saying may lead people to believe that I think this is about to be a good trade opportunity. However, I would really kind of think the opposite here, right? Because it's biotech, and every time you see a chart like this and go, oh no, it's fine, it can't go that low, can it? There's tons of things we have in the back of our mind. You may or may not remember FBRX. This is a great example of that, where people were like, oh, I could sell like a 10 strike put and I'll be fine. That's where support was 3 years ago. But this thing went from $30 a share and is now down below $1 a share. I don't really have any other examples in my mind that I'm pulling a blank and they're escaping me, but this is a great example of the type of price action that you'll see in biotech. So when you run the scan, broader point being is you may see something like MDGL, which is at the top of the scan and offers a 26% ROR at the money. You could go further out of the money and go back to MDGL and see a 13% ROR that far out of the money. But at the end of the day, it is really, really not a great idea. Let's see. We got a good comment on YouTube. We don't seem to roll cash secured puts anymore. Rather just take the loss. Can we talk a little bit about our thoughts on that? Absolutely. Yeah, let's talk about that. So there are some examples of where we roll, right? MSOS, we rolled week over week, right? We had the 11 strike puts last week. We rolled those to the 11 strike puts this week. DraftKings, we had 15 strike puts. We rolled those down and out for a credit to 14.5 strike puts. And if you're in a situation where you're selling options and you're kind of on the fence about, do I add more? Do I change my strike? If you are in a position where you've have a loss on paper in a position and can roll down and out for a credit, meaning lower strike next week's expiry, do that every single time. I mean, that's going to be the safest thing that you could possibly do. You're going to protect your further downside. Yes, the stock could shoot back up and you're going to be saying, oh no, I could have made all this money. But that's a complaint that you'll be making once you have made money, period. And that's always a great problem to have, in my opinion. But I think that may be referring more so to kind of what we did with like ASTS, where we split the strikes and we changed things around. In Affirm, where we had 3 different things and we had 15 different contracts and walked it back to 10. And that's kind of what we talked a little bit about at the top of the stream, right? Where yes, it is very, very simple, and it'd be a perfect world if we had 10 contracts on everything, like even position size. We could roll down and out for credit all the time. But that's just not going to happen, right? The market's a volatile place and shit happens sometimes. So a great way to think about this, if you don't want to do the math of like going from 15 contracts to 10 contracts, what's my break even? How do I manage this? Just very easily, we run, like for a firm, for example, run through the exercise. How much money did we lose last week on it? $1,300. So if we lost $1,300 and we want to go down to a 10 contract size, that means we would need to sell 10 contracts for $1.35 premium in order to make that money back. And again, you don't need to make it all back in 1 week. Chasing losses is a great way to dig bigger holes. So what we did was say, okay, $1.07, that's close enough, because if that hits max profit for us, that's going to make us 1070, and on a 2 week basis, we're down $285. So yes, it's not the classic roll from a week to week basis, but it is kind of thinking along the same lines. It's an instance where, you don't have that perfect, beautiful situation where you could just cleanly roll something for a credit, but you have to maybe do the extra step of math and say, okay, how much did I lose? What do I need to get back to zero, right? Because we love to talk about break-even prices, but what's the point of a break-even price, right? It's just a conceptually easier way to visualize how to get to zero. And if you just do that on the raw numbers with your P&L, you can also accomplish that. So that's the idea there. Great question, though. Thanks for watching. Going back to the scan, COMT, I imagine, is going to be very similar to MDGL. So if we go to COMT, interesting. This is a iShares trust for commodity. And if I had to guess, they're probably paying a dividend coming up here. And a good way to figure this one out is if we go to Market Watch, type in COMT, I imagine we're going to see a big green dot right here. We're not. I mean, they're definitely paying one, right? Because if you look at, you may not see the big dividend announcement. Maybe we'll see it on the chart. No, we don't see it on the chart. But look, the biggest red, siren that alerts us to this is what? The fact that right at the money at 35, we have a 33% ROR. These are going for like $8 for one of these contracts. How much call premium do we see? There's nothing there. When you see 0 and 5, that means there's no bids, no volume. When it's a 0, I mean, those are probably worthless. So you could kind of use these numbers and be comfortable that this is probably paying a roughly, well, you'll want to see where these numbers balance out, right? It's tough because the spreads are so wide, but it looks like maybe in this neighborhood down in 30-ish, they're probably paying around a $5 dividend if I had to guess. So don't fall for it when you see like really, really large RORs here and you look over to the call side and there's no premium. That should be, one of the first few steps you do when you take a look and try to see if put premium that you're trying to sell is worth it. So let's get back to the scan. This is not good because it's a pharma company. This is no good because they're about to have a dividend, and this doesn't actually offer 24.06% ROR, if that makes sense. Third on the list is GH, and again, no idea what GH is. This is why we do the scan. This is why we do our research. Guardian Health, another one that's looks like some sort of healthcare biotech pharma company. They're at least, look, back to the last example we talked about, there's balanced premium roughly at the money here, right? We see 5, 6-ish. We've got 6-ish right here. That's balanced premium. So there's not some sort of huge downside event like a dividend coming out in the near future. But with that said, there probably is a very, very volatile event coming up because we can see there's a $27 low. We've got a market maker move of 11, implying that 35 is kind of the low side here. But 35, maybe not the greatest place in the world to own this one. We see a similar trend with rising implied volatility. Excuse me. I think that was our first sneeze on stream, so I appreciate you guys being here for that milestone. But we could, where can we get 1% here? I mean, it looks like maybe at 30 you can get a couple percent, but is 30 a place I'd want to be here? Probably not, because especially we don't really know what's going on. Looks like they're collaborating to work on some sort of blood cancer diagnostic. I mean, there really isn't a lot of purpose in spending our time reading through this and trying to figure out exactly what they do, because in the context of an option selling strategy, biotech just should be firmly on your do not touch list. Now, if a biotech announces results and they're positive and it shoots up and you still see put premium down low, that's when I like to enter. Once the volatile event is behind you, you have an idea of where it traded before, you've got good news and it shoots up and implied volatility is still a little elevated. That's when biotech is good for option selling. Before the volatile event, not so much, so we like to avoid that. Cold, I think, is one of those energy or like natural gas ETFs. Same with BOIL. MRTX, not sure what's going on there. Rent the Runway, this could be interesting, right? Rent a 2.5 strike put. I believe this popped up on our bot scanners last week because it ran up just so much. And we can actually, if we go to the 20-day chart here, yeah, look, we would have sold 2.5 strike puts just like blindly because we love the fact that there's 10% ROR at the money. But what do we want to do, right? We want to look at a little bit longer term chart. And we don't even have to look that far back. We could see that just like 3 days ago, this thing was trading at a buck 34. So it could very conceivably go back to that. Now, there was an earnings event that kicked it a little bit higher that made that look a little bit better. So, not the worst thing in the world, but not a huge fan of getting in this kind of a setup. We've got Chris W in the YouTube chat asking about SOX. Let's take a look at SOX from an option selling perspective. Semiconductor index. Interesting. And those have definitely been hit hard lately, right? You've seen it with AMD, you've seen it with Nvidia. A lot of them have followed this similar type chart, but we've got the pre-COVID highs, and this is the one place when the market was kind of falling a few months ago when we tried to identify, where do we think a stock is going to bounce off of. The pre-COVID highs seem to generally be where we would see that first bounce. Now for SOX, if we want to apply that logic to an overall index, roughly the 2000 level looks like that's about where that would be. And back in October when this thing had dipped down a little bit further, it almost bounced right off of where that was, right? I think Square is a good example, right? If you draw a line right at the pre-COVID-ish, it's falling, hits that line and, at least initially has some short-term relief. We're not going to say that relief is going to bounce and follow through and it's going to be smooth sailing for the rest of our lives here, but at least initially for the bleeding to stop and when you could expect something to have a bounce, that pre-COVID high is a great example. And I kind of wonder what Square is looking like these days. Looks like you can get some pretty decent premiums on the thing. Interesting. Is this thing, for whatever reason, no earnings anytime soon? Looks like it's offering about 4.12% at the money, meaning you can go half size position at 61 strike for a buck 36. That doesn't look too terrible. Might have to keep that one on the list because if we look at where it's been bouncing off of, I don't know if I love 60. We've seen low 50s. If we draw a line at 60, I gotta be honest, that lines up pretty well. Implied volatility is getting sucked out of this a little. RSI is kind of on the wrong side of 50 for us. If this falls back down, it may be a good one to keep an eye on. Let's just put that on the watch list for right now. Let's just go SQ 60p. If RSI is less than 50. So that's going on there. Let's get back to the scanner, see if we can find any just random crazy trades. SI, that one has been a mainstay on this scan. We know that one is a crypto holding company. Just a little too much risk in that space for me. CLNN, interesting. Let's see what's going on here. Clean Ink. What is this thing? What do they do? I don't know what this is, but I gotta be honest, as crappy of a stock as this looks, this is exactly the kind of chart that we like for this kind of a stupid little trade, right? It's trading right at about a buck on the money. The low is 87 cents. We haven't seen anything too far below that. We've seen it go from 90 back up to a buck, so that's decent. But look, if you could fire off one of these things for 10 cents, not only is that an 8.11% return in a week if it just stays above 1, but you also have a 90-cent break-even price, meaning as long as it stays above there, you're good to go. And that seems pretty likely with where this thing's traded over the last 20 days. Looks like they've already announced earnings back in November. This is a healthcare stock, though. So another thing to keep in mind, probably would strike it from the list for that reason. Let's maybe scroll down a bit. Actually, let's focus this scan a little more, right? We've got 1,234 different stocks that have really objectively high premiums, but we've talked a little bit about RSI and why that's one of our favorite technical indicators. Let's cut this list down a little bit. Let's intersect it with the list of oversold stocks. So we could just isolate those results where RSI is where we like, and we get a really, really nice focused list of 15 here. Now, some of these are going to be duplicates. MRTX, I guess we'll take a look at it. It just, that ticker just sounds like a pharmaceutical stock, doesn't it? There you go, therapeutics. This thing is truly something. And this is, the beauty of this intersect feature that we had on the scan, right? Sure, implied volatility was high back over here, but now we're catching it maybe after the drop. Where is it going to stop the drop? Who knows? We back out a little bit to maybe find where it'll find its legs. High 30s, low 30s. This range right here looks like it might be a good spot. Implied volatility still definitely elevated, but the first thing that we want to get comfortable with here is why did this thing drop so much? Let's see. They've been downgraded, downgraded, downgraded. What date was this actual dip? The big dip was happening around the 6th or the 7th. Looks like they have favorable data. Interesting. Phase 3 trials going to final analytics. Maybe that's potentially pending. Interesting to see that this has fallen so far without any... There you go, Jeff Ha. Good question in the YouTube chat. There is legislation on the floor that's going to impact MSOS. That's why the option premiums are so large here. But with that said, one, there's no guarantee that it, either gets introduced or makes it through or sees its conclusion this week. There was elevated premium the last couple of weeks, so at some point something's going to happen. But with that said, we do feel that the premium on MSOS is super, super high and can handle that, right? Cannabis industry is one that I think long term has a future here. So even if nothing happens this week from a legislation perspective, I don't think that's going to kill the industry or anything like that. So it's a place I'm still comfortable to be in. We've got a half-size position, so if it does get crushed, we throw more money at it, and then wherever our break-even price lands is where our break-even price lands, and we kind of stick with it. But MRTX, we're trying to get to the bottom of what's going on here. 3-year chart, I mean, that 32 number looks really low. Big question for me is how low can we go and still get some decent premiums here? And it looks like 30 might be the number, right? So we've got the market maker move of 945. That would suggest that the downside here is roughly 32-ish per share. Okay. So if we go, let's finish out this exercise. If it's 32 a share, that's where it sticks us. It may not inspire confidence that this thing has gone from 101 to 41, and that's why we hate these like healthcare stocks like this, because you see these massive, massive dips. This one doesn't necessarily look like it was driven by anything too particular, if that makes sense. This lines up so nicely with where we already saw a low earlier this year. I'm going to do a quick Google search. This is like one of those things where I feel like I got the devil on my shoulder here about this one, MRTX. Stock news, let's see what's going on. Why it lost half its value this week. Now we're talking. Let's pull this on here. We'll have a little Sunday night reading session together. Why Mirati Therapeutics stock lost half of its value in just 3 days. They said 49% of their patients with advanced lung cancer responded to a regimen using its drug. But that wasn't much better than the 48% response rate for Keytruda plus chemo. They've yet to, demonstrate a benefit. Shares are down roughly 54% since then. Interesting. So I guess the issue is they have to demonstrate that their drug is at least better than what already exists, and the data doesn't necessarily support that. But it seems like that kind of is the bad news. It seems to me like the cat's out of the bag here. Can this thing keep dropping? Absolutely, but I guess question 2 is this something that I want to keep holding on to if it does keep dropping? I don't know if this is the type of a dip I can get comfortable with buying into, right? Because the idea here would be like if you can get 75 cents on these things and you sold like, 4 of them, you're looking at a pretty decent $300 profit off a very, very large cushion. Very decent margin privileges on this stock, which you don't typically see in these types. The news seems to be behind it. See if I got one more article here talking about if this is a good one. I think it may be one of those. Yeah, it's one of those articles written by AI, which tells you absolutely nothing. Might be worth looking a little bit into. Let's you know what? I think my consolation here is to just put this one on the list. And if it has another big leg down, then maybe we jump in at 30. If these 25 strike puts wake up a little bit, I think I'd find that interesting if we can get 50 cents or more on there. So let's go MRTX 25 strike puts if they're worth more than 50 cents. Why 50 cents? Because that would be a 2% ROR on that position. So, yeah, fridge opener. Great point about dilution. I can't find any news about dilution. I think it really is just the fact that a lot of the value in their stock was based on the fact that they had this drug, which was supposed to potentially be put into play, and just isn't demonstrably better than what already exists. And the other thing you want to think about for these biotech companies, you know, I say we hate biotech, but we've got all these little tidbits about it, and it's only because I used to trade this stuff and I hated it. But you want to be comfortable with how many things are in the pipeline, right? If that was the only drug they have in the pipeline and it was not demonstrated to provide any benefit over what already exists in the market, it's like, okay, it could go pretty far down. But if like they struck out with a lung cancer drug, but they have like a liver drug and like some other drug and like other things in the pipeline that they could potentially derive value from, that's when you're comfortable jumping in on these things at a certain value. But I don't I don't really know. I think maybe I saw something about a liver drug, or that might have been another one we looked at a little bit earlier. How about this? We'll put another note to ourselves here. Check pipeline. Let me put that here so we could actually see it. All right, so we got two on the board. Let's keep going down the list. Let's keep looking at these oversold things. That was interesting, right? SI, let's just throw it up there, right? We know earlier that I'm personally not partial to it because it's like a crypto related stock. They've got all these holdings. We've seen this trade at like $13 a share before. But it is tough to turn your nose up when you see returns of like 2.2% ROR at a 15 strike here, which look very, very nice, especially on like a 180-day basis, right? I mean, that is a crazy drop off from where it used to be. And this is tough, right? You've got this really nice intersection, which is what this scanner tries to give us, right? We've got this really nice intersection of low RSI, where the 180-day RSI is at 37, and I think if we go to 1 year, it's even worse, right? 28, right? It's at 28, and from an IV perspective, it's soaring, right? And when we see RSI go down and implied volatility go up, and we have some sort of support that we could look at historically if a stock is cratering, that's usually a decent entrance. But the issue here is, where did this thing start to take off? It started to take off from like, okay, it started to take off from like the 14-ish level. Interesting. But with that said, there's a lot going on from a bankruptcy perspective as well in the crypto world. I think I would want to be comfortable about where they are getting their money from. Let's see. They've sustained downgrades due to crypto exposure. And one thing, let's just use that tool in our Discord server really quickly. Let's pull this over here. Go to the charting channel. And there's some spam that I need to manually delete. Whoops. You could really easily just pop into our Discord server /DD analyst and then just type in SI, and it's going to give you a list. Whoops, it didn't work. It might be because there's no ratings we could find. Let's see if we could find anything. So adjusted to 24 from 37. That 24 is really the only one I'm kind of seeing here. Let's move this back off the screen. This might actually be an interesting one where we take a dive into the financials. We haven't done that in a little bit of time here, right? So how do we pull up things on the financial statements? The answer is we go to Google and you try not to minimize, you try to maximize and don't completely whiff on that. You go SEC Edgar, and that's going to give you the SEC Edgar Search and Access Database. Click on this one. Maybe click on the second one. Little trial and error right there. So you type in the symbol right here. It's going to give you Silvergate Capital Corp. And what we want to get comfortable here with is the amount of crypto assets they hold, where the value on this stock is coming from. 10K usually is a lot more information for us, but that's back from February. Let's go to the more recent unaudited 10Q. And quarterly financial statements are never audited, but they are reviewed by accounting firms. So there's a little something for you. Let's see. We've got the statement of financial condition, which is going to be the balance sheet. Securities available for sale at fair value. So I imagine this is what the crypto is. About 8. These are in thousands, so this is about 8.3 billion in crypto, and that's of 15.4 billion in assets. So it looks like they hold their customer deposits in there as liabilities. And it looks like, they've got about 12, 13, 11.4-ish of crypto assets. That roughly balances that out. That's nothing too crazy. Let's go down here a little bit and see if they've got the MD&A for management discussion and analysis. You've got notes to the audited financial statements. This stuff at the top is normally pretty boring. But the further you go down here, you're going to see what their debt securities are. So it gives you some information about asset-backed securities, municipal bonds. It actually doesn't look like any of this is crypto. It's all, mortgage obligations, government-sponsored loan pools, tax-exempt muni bonds. So let's try to get to the bottom of what actually the crypto is. And they only mention crypto 6 times in this 10Q, which tells me that maybe we need to go look at the more extensive 10K to get to the bottom of what the hell's going on here. And they say crypto 0 times in these filings. Really? Really, really, really? That is surprising. So another vein of research that we could pursue here is Silvergate Capital, and just type in crypto exposure and see if someone else has gotten to the bottom of this. So, few things that are important here is it looks like there was some rumored exposure to FTX, which obviously is the crypto exchange, which has gone bankrupt. Their relationship with BlockFi is limited to less than 20 million of its total deposits. And those total deposits, as we just saw from those financials we looked at on the balance sheet, were 13.2 billion as of Q3. So apparently they've lent some money to these crypto firms. See if this has a link to this article it's talking about. The Wall Street Journal. Here we go. This was published, and I don't have a subscription, so we're not going to find out what that's talking about. But they surged on confirmation that they don't have exposure to FTX. Their FTX deposits represent less than 10% of the 11.9 billion in total deposits, meaning that they're a creditor. So they already have the money. That's fine. They've been downgraded. Let's read these downgrades here. I'll tell you what. Definitely a little bit riskier, right? We see the premium there. We know that there is some involvement in the crypto space, but what we've seen here, look, I mean, if you've got a bank doing something like, let's just zoom this chart back out. You have price action on a bank on a 3-year basis that looks like this. That's a little suspicious, obviously. But when it comes back down and gets back down to this more fair level in the low to mid teens, it seems like that might not be a horrible place to be. And the other thing we could potentially do here, right, if we wanted to protect ourselves against like complete disaster, because the good news is here, these are weeklies. These have weekly options. Is we can make some sort of a spread potentially, and we can make a calendar spread, meaning that if we go out to like January and we want to commit ourselves to this trade for like 3 or 4 weeks, we can maybe buy a 10 strike put for 50 cents. And the idea is we just have to sell 50 cents of premium between now and then. Let's think about what we could potentially want to do here. I mean, going 1 week, 15 strike put is very enticing to me. I think if we sold 5 of these, the other thing is I can't imagine we get too much help in the margin department here. But if we sold 5 of these we actually do. We get a lot of help in the margin department, which is very, very interesting. But with that said, we could sell 5 of those, have like a 1470 break-even price on a 1 week basis, and that's not a horrible place to potentially own that because we know it on a 1 week basis, there's like $1 premium at the money here. So even if it did fall, we could potentially help ourselves out a little bit. I do wish they had some lower strikes that we could potentially hedge out with. One thing I would maybe think about doing is going into something like a 13-15 credit spread, where yes, it's going to take about 10 cents of value away, but like if there is some crazy issue where this bank just completely implodes, you're going to be protected on the downside by that long put. And that's going to give you 17 cents instead of 30 cents if you can get the fill. And that's decently significant, to be honest. I might just go with the single leg half size position for now. But another example where if we know that the market's going to be volatile, let's take on a non-market type of risk, right? Let's maybe venture into these financial institutions that have been a little bit embattled, and RSI is just in the absolute gutter. So I think SI 15 strike puts, not the worst idea in the world, right? 15p. And the good part about those, right, if we put this in our break-even tracker, we know that our break-even price would be 15 minus 0.3 would be 14.7, meaning we would have a 31.4% cushion in the coming week. So no matter how volatile the overall market gets, I mean, you probably would need some company-specific news in SI in order to not make money on that type of position. So I do like that idea, right? So that could be on the shopping list early Monday morning. And let's finish out this scan right here. PBF. What's PBF? PBF Energy. That is just way too high. Although it's fallen back down a lot, I'll be the first to tell you it's been getting absolutely crushed. Volume. Oh, these are spreads. No wonder it looks weird. Let's see. Yeah, I mean, look, this thing has dropped like $15 in the last month, and you can't really get any premium more than $1 out of the way. That's instantly do not touch that. XOP is next on the list. XOP is an oil and gas ETF. Very interesting to see that on here, but that one has been getting smacked back down lately. I do like the fact that this is an ETF. Implied volatility maybe isn't as high as we would like. But we talk about areas of support. It looks like 125 is coming in hot right here, right? We've got some pretty well-established bounces on a 180 basis right around here. Next level below that potentially is about the 115 level. Let's zoom out a little bit further to the 3-year. This is definitely a little bit scarier. But look, it's an oil and gas ETF. This thing isn't going to turn south overnight, so you can at least maybe rest a little assured in that sense. Yes, on a 1-year basis, we've got this thing back down into the blue, and we've seen it down into the blue before, right? And it bounced right back up after it hit that support level. But let's see. Let's just finish the exercise. Why not? Why not? And it looks like we can get 1% at 125. I don't hate that at all, to be honest with you. The other thing is that oil and gas obviously goes up in an inflationary environment, which is why we've kind of seen this thing run all over the place, mostly bullish during what's been a very bearish 2022. Oil and gas has done, and just the energy sector in general has done a very, very good job this year. But as that falls back down, maybe a hedge against potential bad inflation news. Uh, yeah, like if core CPI shows that these prices are falling, we could definitely see some outflows of cash there. So 125, look, we don't want to go 100% position in at 1%. We would like to go half percent or half position size at 2%, which we'd find at 128. And the good part about that at that 128 size is, yes, we think 125 is, where support would lie, and 128 is above that. But look at the premium we're getting. We're getting 255 of premium at 128, meaning that our break even would be around 125.5. So while our strike isn't exactly right there, our break even price is. And if we have half position and it gets down to 125, then there we go. We're at support, we throw more cash into it, and we keep the line moving. The other thing I'm very curious about here is what the margin buying privileges look like on this one. And the answer is very, very good again. For a $12,000 position, it only takes like $2,300. So almost a 10% ROC. So, just go crazy. Leverage up your entire account. Let's get it going. Uh, very poor advice there. But out of curiosity, if you wanted to sell 100 of these, it would only, if you wanted to sell, how about 50 of these? Just because I'm bored. $118,000 is what that would take. But you'd make 12 grand, so, there you go. Don't do that. Start small, scale into a normal position. And I like the idea of doing that, right? We didn't see this level since the end of September. 125, we saw that back in April. I think we definitely have some bounces after how many red candles we've seen in a row here. Could we be in a similar position to this? Yes, but where did this bottom out? This bottomed out when RSI hit the yellow line. And that is held true historically on a 1-year basis on XOP. I like the idea of adding 128 strike puts on XOP, and that is something I will add to my shopping list. 128 strike puts. The last thing I want to check is make sure that they have weekly options on these things, and they do, so we can continue to lower that break-even price or roll week after week after week after week after week. And what's very, very interesting here is just how much more premium these things kind of have, right? So you can get 2% at 124. That wouldn't necessarily be the equivalent. It looks like they just have more strikes. No, they don't. They have the same amount of strikes. I think we stick with the 1 week. When in doubt, always sell that nearest expiry. But this is a very interesting way to maybe introduce some oil and gas into our portfolio while taking advantage of a situation where it's a little bit oversold, and use that RSI technical indicator to help us out a little bit there. It's an S&P oil and gas ETF. This thing's not going to go to zero overnight like something maybe like BOIL, which is like one of those crazy leveraged energy ETFs. It's not this. It's safer than this, while still offering what I think is some decent returns. I click on the wrong thing and make it look like I know way more about this than I do, but couldn't tell you what that was. Back to the grid. So we've got these 4 things on the wish list potentially for the coming week. Let's get to the bottom here. We've got SU, which is offering a 29.5 strike put for good premiums, and apparently this stock is oversold as well. And we've got another energy company. Now, if we're going to get into the S&P 500 energy ETF, we probably don't want to get into this as well, because that's not a very good example of diversifying our positions. So while these setups are almost identical, and I'd imagine that we probably see premium at like the 28.5 range, similar to what we saw in the other one. Am I right or am I wrong? Half right, half wrong. Close enough. In the 29ish range. I just don't like the idea of being in an individual company like Suncor, because look, on a 1-year basis, it went from 22 to 42. What's that? That's doubling in price. We go to XOP, it went from 88 to 170. Well, what is that? That's also doubling in price. Price action wise, I'll be the first to tell you those are very similar. Not what I expected to see when I pulled that up, so that point's a little bit moot. But I do think the point of being in an ETF as opposed to an individual company does hold some weight, similarly to how we've invested in MSOS as opposed to some other individual cannabis stocks. Let's keep going down here. NRG. Well, let me take a wild guess what what sector that one's in. Energy. So this one has gotten actually slammed the past week or so. It's really at a one year low. I believe they sponsor the Houston Texans Stadium. That's where I've heard the name. Price target's been adjusted to 37. We've got a market perform rating with the price target adjusted down to 43. We've got a $30 price target, which is maybe unusually low based on some of the other numbers we've seen here. Not a lot else. Well, let's see what kind of strikes are offering, what kind of premiums. And we can't even find 2% out of the money on this one. That seems like far too much risk for me on something where we just watched it go from 40 to 32 in, about a day. So that's a no to NRG. PXD, couldn't tell you what that one is. The strike looks like it's at 210, so that might be a little bit more expensive. Tell me that did not just say PXD. It does say PXD, right? Did I type that wrong? I did PDX, Portland Airport. Nice. Here we go. We still can't find 2% ROI out of the money. That's a natural resources company. Have been beaten down a little bit, but that's what all these stocks are on this more focused scan. Looks like there's still a little bit of ways to go back down to this 200-ish level. Not a fan of that setup. NNDM. I remember this one. Well. Nano Dimensions. This was one of those Cathie Wood stocks where everyone thought she was a genius until they all decided to kind of shit the bed on her a little bit, right? There you go. The typical Cathie Wood stock chart right there. Where she bought in here, looked really smart up here, but continued to buy, and then got slaughtered on the way back down. But with that said, it's back down to 207. We've got 1.52% ROR sitting at a 2-strike put, but let's be honest here. There's only 72 of volume on these things. These are going for literally $3 a pop when you consider the total profit you'll be getting from these. You would have to sell probably far more than the market would be willing to sell you. And when you're only getting like 3 cents of premium on a contract like this, commission is absolutely a consideration that you need to have in mind. So not a huge fan of this one. Leave that alone. And I believe that takes us to the bottom of the list. Now, the last thing we want to do is potentially take a look at the overbought stock one as well. This worked out really well for us. We were 2 for 2 on it last week. We also called out Yeti as a potential bearish position. And that one actually worked as well. We just didn't take the position. We've got some things on this list that are very, very overbought and potentially need to be played back down because they have too much premium. What are those things? We've got Rent the Runway, which we already looked at because of the fact that it has a really, really high return on it. It's kind of been flying. I don't love the setup of playing something bearish on this, mostly because if we get a Rent the Runway, okay, I'll be the first to tell you these are not hard to borrow, which is typically what you might expect. So potentially surprising to see that. The calls are going for about 20 cents a premium. That only gives you protection up to like 270, which is nothing for what this thing has done. Far too much risk on selling calls on something like this. And I think that's going to be the case for a lot of these, right? If we go to Momo, what is Momo? The Hello Group. Massive, massive spike in this stock after earnings. RSI is absolutely through the roof, which is what we look at, right? This is the purpose of this isolated scan. We go to the 1-year chart. We see that big spike in RSI. That coincides with the spike in implied volatility. That's kind of a setup that you would like to see for an IV reversion type trade, meaning you would want to sell something back down at like the 6-ish level where it took off from. However, we're looking at this kind of after the fact, so I seriously doubt you find any premium near 6, right? You get 1% at 7, which is a little bit too high for me because that falls over here. Now, what we can do potentially is take a look at the trade tab. These shares are not hard to borrow. It doesn't look like it's heavily shorted. So that kind of works in our favor a little bit. Let's see why it spiked. Hello Group, where are you? The price target was raised to 9. It's a beneficiary of the Chinese reopening because they've had some restrictions lately due to COVID. And I don't really see a whole lot beyond that. So what could be an interesting trade here is to say, look, this thing's at 893, RSI is through the roof. It's probably going to take a little bit of a breather. Implied volatility is spiking. How can we take advantage of that? And the answer is just make a bearish trade by selling calls. However, what we see here for the next week is the fact that you could sell that 9 strike for 60. You know, it only takes about $3,400 of buying power. You'd be protected up to 960. Because what we're looking at here is the fact that this thing peaked at 1031. Ideally, I'd like my break-even price to be at or above that. We can accomplish that by selling a 10 strike for 350. So we can get a 1035 break-even, and if it kept running, we potentially could, roll it up and run the reverse wheel on the thing. But with trades like these, you always want to be cognizant of that upside risk. This doesn't really look like it's liable to make an insane run like that, but I could definitely see it pushing this secondary level here of like 11 or 12 a share. So the way that we could probably best protect ourselves from that is by getting into a vertical credit spread between 9 and 11. 9 and 10 only gives you 30. 9 and 11, meaning your break even would be 930. Going between 9 and 11 gives you an extra 10 cents, putting your break even price at 940. You'd risk about $1,600 at max loss, but potentially make $400 if it comes back down. The way RSI is working right here, the way implied volatility is working, you're getting good option premium. RSI is begging for this thing to come back down. So I got to be honest, I love the idea of a bearish 9-11 vertical call credit spread on this thing. And if it breaches that, what can you do? You could close out that 11 strike call for profit and then just let the 9 strike call run as a short position. We did that the other week with the Unity and it worked very well. And I bring up this longer term chart because it doesn't look like there's a ton of huge spike risk, right? If we were looking at something like an AMC where you see these massive spikes, these huge candle wicks, yeah, there's absolutely a risk for a spike. But when we look at Momo, we don't see that. It's much more gradual. So I'd be surprised if something like that happened. Now, I don't want those to be my final words before the market kills me and then that actually happens and I lose a ton of money. So what do we do to protect the position? We're just going to sell a 9-11 credit spread. And this is another position that's probably a little bit independent of the overall market, right? So I love the idea of a Momo 9-11, 12-16 expiry. And that's going to be, going to be a call spread. And we're going to try to get that puppy for about 40 cents. Now, one extra consideration that I might have right here, and if it's, because we looked at a 9-10, and a 9-10 offered 30, and a 9-11 offered 40. But adding that dollar, but only getting 10 cents back doesn't seem like a great trade-off, right? Because we go from $400 off 1,600 risk, which is a 25% ROR, where if we pop it back down to 10 and get 30, we've got 30 risk off $700, which is far higher. Let me give you the actual numbers so I don't say something really stupid here at the end of the stream. But a $300 return off of a $700 risk is a 42.8% return, and your break-even price is only 10 cents lower. I like the 9-10 way better if you can get that fill for 30. Let's try this. Let's try this first. Let's do the 9-10. And we'll try to get that fill for 30. And if we could get that, that's fantastic. That could potentially bring us back home $300. And another one that's very, very easy if it falls back down to just close out for like 10 or 15 cents and you bag 150 or $200 of profit very early in the week. So let's call this one bull. Call this one bear. And this is the advantage of these scanners that we're using, right? And let's make bear like red. Yeah, gross, not highlighted like that. That's a little aggressive. Let's make that red font. Thank you for bearing with me as I format my little spreadsheet. We'll make a little too light of a green. I don't know about that one. Oh, but there you go. I like the list right there. We've got a good bull list. We got a good bear list. Let me grab one more for a potential bearish position. Let's see. TME. I know that's a little bit scary of a stock right there. MLCO. What's MLCO? Melco Resorts and Entertainment. Another ADR. Foreign stock. High premiums. This one's got monthly options though. We want to be careful with some of these because we lose a little bit of flexibility in the trade. We've got this thing running hot. We've got the 3-year chart up right now. We see some decent points right here. That's definitely one that we can identify at 15. Looks like we've got another, right, where it kind of tops off a couple times right at 20. And then maybe support. It's kind of breaking through. Let's see. I would think the last support level, or I guess support/resistance is right around here because we bounce off of it and then we bounce off of it twice right here. So, and it looks like that's the top of the candle. So it may be hitting that and coming back a little bit, but we go to the 1-year chart. We see that RSI absolutely through the roof. Implied volatility not as relatively high as we saw previously, but still pretty high, and it's reaching an area where I thought that, oh, Abdul Hamza, appreciate the follow, and we're reaching a level where I would pretty much think it's falling back down. So what do we want to do? We want to scroll back and see these levels we've identified. Top end of the range is 15. We're currently sitting at a range where we think it's going to come back down off this level. Probably could go up to this level. Let's see what we can do from a credit spread perspective. And I love the idea of just like there's two things you could do here, right? And they're going to give you very different types of value. The first thing is you could just go out of the money, do something like a 12, and maybe turn it into a spread because, look, there is some upside risk to 15 that we want to be cognizant of. So if we go to 12 and then maybe buy like a 14 behind it, we'll in theory get like a 25-cent credit. There's definitely a lot of risk on that, but the upside is the fact that your break-even price is going to be 12.25, which is right around here. I don't know if I necessarily love that one as much because, look, we've seen this thing go from 4 to 12 in like, a month. The thing's absolutely ripping. Let's see what the news feeds are saying. Yeah, it's about these reopenings in China and Hong Kong causing some surges. So I don't know if I necessarily want to get in the way of that. Like, I'd love to have a break even like up here-ish, maybe a little bit closer to 15-ish even. But the other potential avenue we could take is to drop down to 11. And you'll notice we go from a 25-cent credit to a 65-cent credit, which is decently significant, right? We still have that break-even price. It goes lower, right? It goes from 12.20 to 11.65. But one, that's above where it's currently trading. And two, the little prize we have waiting at the end of the tunnel for us is $650, which is a lot more attractive than what we were previously looking at. So maybe that could be an idea. I don't know if I love the idea of hitting that, though, after it was already down 2.5% on Friday. So maybe keep an eye on that one if it spikes up any further. So how about MLCO? We'll go call it 1214C if we see a spike to 12 plus. So how do we know if we're going to see a spike to 12 plus? You simply just go to Market Watch, you go to Alerts, and then you put in a new alert here for that symbol, and it can give you an alert when that reaches 12, so you'll know. But I think that's a good, decent list to start off with, right? We got some good bearish positions we could potentially mix in there, and I think we've got some really, really nice bullish options that are a little bit removed from overall market risk. And if we want just typical positions to jump into, right, we've always got our watch list right here with some of the ones that we're a little bit more familiar with where we could easily scale in or out if need be. Futures are relatively flat at negative 0.15%, but I think we've got a really, really nice plan for the coming week. But we don't want to do too much too early. And we're wrapping the stream up right now. Let me go fireside chat, full cam. Really important thing that we cannot emphasize enough about the game plan this week is how risky the FOMC and CPI combo is going to be for the market this week. So with that said, yes, it's great that we have this wish list that we've outlined on the stream. It's great that we're only using 31.79% of our buying power because we have flexibility to add more. But what I really, really want to emphasize is that unless we see a trade that is like an absolute home run, we shouldn't be adding any bullish positions before CPI and FOMC because things can get better and that'd be fantastic, right? We could actually switch back really quickly here to this. And if all of these expire worthless, 0, 0, 0, 0, 0, 0, and the market shoots up, we're making $5,380 next week without touching a single button if the market goes up. But look, if the market goes down, that's what we want to be ready for. So keep that wish list in mind, stay confident, stay patient. Most importantly, just never get into positions that are too big for you to manage. And if they do get too big to manage, it's okay to take a loss at some point because I would much rather be in a situation, where my capital situation is a comfortable one and I'm not being margin called, as opposed to being super leveraged in one position that could make me some money back, but also could break me and dig me into a pretty large hole if it goes against me. But until next time, this has been the Hourglass Trader, where as time passes, we make money. We didn't make money last week, but overall, we're outperforming the market at a very, very high clip. Our goal is to get back and be positive overall on the year, and I don't think there's a reason we can't do that and finish off 2020, which has been a historically bad year for the markets. I think we absolutely can still finish that in the green. So thanks for those of you who have tuned in. We'll be doing this thing same time next week, hopefully with a little bit more money in our pockets than we had tonight. For all of you who tuned in or are watching the replay and made it to the end, thank you. Hourglass-trader.com if you want to sign up for HD Premium or join our Discord server. The link is all there. Completely free to use the strategies and learn the strategies that we use. Our week stream is also completely free. Just kind of teach what we do and kind of share the mindset that we approach every week with. But if you want to be alerted to the actual trades we make as we make them, be involved in the daily discussions, have some additional analysis to really, really hone in your tools as a trader, that's where HD Premium comes in. And that is the end of my self promo. But thank you guys for tuning in for another week. See you guys same time.